Hello, everyone. This is Professor Purusha again, and I want to give you some of the highlights from Chapter 4. Uh, the book's coverage of the material in Chapter 4 is quite good, and so is the accompanying online lecture on the Connect site. In this lecture, I'm going to highlight some of the big things I want you to think about as you go through this chapter. Um, the goals of this chapter are to learn about some of the common types of financial services um, consumers need, uh, to learn how to compare things that you might want to think about when you're comparing the types of financial institutions. We're going to, in this chapter, assess the different types of savings plans. I don't cover this much in this overview. That's covered quite well in the chapter itself. And evaluate different types of payment methods. And that's something I'll talk about here and is also covered very nicely. In particular, we're going to talk about the difference between debit cards and credit cards. In terms of types of financial services that consumers often use, you can think of one class of accounts could be savings accounts. A name that often is used to describe a savings account is something called time deposits. That's kind of a traditional term for it. Similar to a savings account are something called certificates of deposit. Certificates of deposit are slightly different in that you commit to not withdraw your money for a longer period of time. So with most savings accounts, you can withdraw your money as needed. A certificate of deposit, you may commit yourself to deposit for 3 months, 6 months, 12 months, 5 years. And in return for this longer commitment that you'd keep the money with the bank or institution from whom you've purchased the CD, they'll give you a higher rate of return. So you get a higher rate of return for the lack of liquidity. Sometimes that's attractive. There's also a set of things you might think are payment services. All right, so in my mind and in the textbook, you distinguish a savings account, which are typically not accounts used to be paying your bills, versus accounts like checking accounts, which you can use to pay your bills. Time deposits were the traditional name to refer to savings accounts. Demand deposits, you might hear the term that's being used to refer to something like a checking account. All right, and that's the idea that on demand you can write a check and the firm who now holds the check in your hand can demand money from your checking account. The difference is sometimes morphed now because sometimes savings accounts you can set up automatic payments, and you can tell your bank to either withdraw the money directly from your checking account or in some cases from your savings account. So for instance, you might have a cable bill that comes every month. You can have it set up where the cable bill actually can bill the bank directly. You get notification of the amount of the bill, but the money comes out without you paying or writing a check or doing anything. It's kind of automatic. That's often quite convenient, and depending upon your mastery of budgeting, which is something we've covered in an earlier chapter, it's often the case that automatic payments are a very convenient way to pay for the regular monthly bills, things like electricity, gas, cable TV, your phone. Having these set up as automatic payments is quite convenient. Sometimes you need to borrow for the short or long term. So for instance, you might need to borrow money to purchase a car or purchase a house. That will be financial services that you'll need. And I'll also mention there are other broader, one of the big changes over the last 20 or 30 years is kind of the blurring, the distinction between traditional banks and kind of new types of banks like mutual fund companies and other investment houses, insurance companies that offer bank-like services even though they're not a bank. So for instance, large money management companies offer a cash management account which allows you to write checks on what is in fact a mutual or money market account. And so the lines kind of get blurred because similarly banks which traditionally did not get involved in investing now can often also provide investing services for you. One important thing to distinguish is that if you are having a savings account or a checking account at a traditional bank, your deposits are insured by the federal government up to a really large amount of money. So all but a kind of exceptional accounts would have their savings and checking account insured if something happened to the bank and it went bust. On the other hand, things like money market accounts and other types of investments at these non-traditional banks, insurance companies, investment houses, asset management companies more broadly, those are not insured by the federal government. So it's particularly important if you have money invested with one of these more like investing houses, you would like to be sure that you're working with a very reputable company because you don't want to risk losing money due to poor performance at that institution. Two important developments in the last 15 years that are really changing and continuing, we're going to see change in the banking sector. One is the rise of online banks. This is really unheard of until 20 years ago. Now online banking's becoming, basically a footprint in the banking sector is getting bigger and bigger. These are banks with really no physical building, and you do all of your banking with just essentially the internet. You can deposit checks with your smartphone or tablets. You take pictures of the checks. You can use a variety of ATMs. Often these online banks have ATMs. Sometimes they have arrangements with other banks. I've listed two websites here on this page, checkingfinder.com and bankrate.com. These are both good websites if you want to investigate and learn about some online banks. Online banks typically offer higher interest rates than regular banks. Of course, the cost of an online bank is there is no physical building to go to, and that may or may not matter to you, but it's something to at least consider. I know it's now common, in fact, for people to have both a physical bank and also have an online bank. So you might have a physical bank for certain spending you do, like for instance your regular checking, and you have an online bank for kind of your safe money. You often need a rainy day fund. You might keep this money in an online bank because it gives you a higher interest rate. One thing I want to stress to you is the importance to investigate fees at online banks. In fact, more broadly, you want to investigate fees at any bank you choose. Okay, almost all banks have special programs for students. Banking fees are a huge source of revenue for the banks. They can charge you for almost everything you do at a bank. There are banks that charge you to use their ATM. There are banks that charge you to go to the teller. There are banks that charge you if your amount of money in your account falls below a certain level, say less than $100. You want to choose a bank that imposes the least number of fees on you. Online banks often have programs where they reimburse you for ATM charges to make up for the fact that there's no physical bank you can go to. I want to stress the importance of keeping an eye on banking fees. Okay, it's been a huge controversial growth in bank revenue is to charge fees to customer for things that used to be free. The other thing I want to mention is mobile banking, and that is with the advent in the last 5 years of smartphones. People are able to do a lot of banking transactions, bill paying, check deposits from their phone or desktop computer. It's something that you should learn how to do with your bank. It's often quite convenient to do. Rather than write checks, I almost always now just pay everything from a website, and I think you'll find that quite convenient too. Basic questions you need to think about when you're choosing a financial institution. You know, in many cases, people just choose the same bank or institution that your parents had. That may be good, it may not be good. Right, your parent situation may not be the same as yours, and while the bank that they go to may be an excellent bank for people in the middle of their life with more substantial amount of money in the bank, it might be a terrible bank for a student with who have low amounts of their accounts, and you could get just feed to death where you get $3 and $4 fees every month, and it turns out to be very expensive. If you have a savings account, which I hope by the end of this semester you're all going to be able to move towards, even as a student, to saving a small amount, perhaps regularly. What bank can you get the best return on my savings? I am a Bank of America account holder, and Bank of America is terrible on savings accounts. So they give a very low return. Online banks give us a more substantial return on savings accounts. Number two, you need to ask the question, how can I minimize the cost for financial services? And in fact, I would say probably for most of you, given that you're going to be choosing from traditional banks, which are insured, this is perhaps the main question you're going to need to ask and answer. One type of cost is time and convenience cost. Okay, how difficult is it for me to find an ATM when I need money, an ATM specifically that will not involve a fee, right? So sometimes if you use an ATM from a different bank, you can actually get the money out, but there'll be fees charged. So time and convenience cost. And number two, the cost of services. There are, as I said earlier, banks can charge you for checking accounts, savings accounts, pretty much anything you ask from a bank now, they're going to charge you. I would think it's very important for you to find a bank that has no charge checking and an excellent ATM program, whether it's their own set of ATMs or they have a program to reimburse you for ATM fees from other banks. Finally, you may want to ask the question, will this be the type of place that I'm going to be able to borrow money if I need it? You may need to borrow money to help pay your tuition or fees a given semester. So I wouldn't put this at the highest of my categories, I think, for most students, but it is an issue. Quite often it's the case that if your money is with the bank or credit union, you're more likely to be able to get a loan, and that might be something you ask when you're shopping around. I need, out of good conscience, to at least mention there is actually a large number of very problematic financial businesses that you should try to avoid. While it makes for excellent television, pawn shops are a terrible deal for people who are using pawn shops as effectively as a bank. That is to get short-term loans in order to pay bills. The annual interest rate on pawn shops is extremely high. It would not be surprising for you to pay in excess of 30% a year interest on a pawn shop loan. And that is absolutely insanely high interest. Um, there are also a large number of what you can kind of think of as check cashing outlets. These are places that, for many people who are low income and have low net worth, that is, they're not able to save for one reason or another, they go to check cashing outlets to cash paychecks or whatever other checks they have. These places charge anywhere from 1 to 20% of the face value. So that might mean if you have a $100 check, they will charge you somewhere between $1 to $20 to cash the check. So just turn the check into bills. 1 to 3 or 1 to 5% is probably average. But again, that's extremely high rate. This is a service that's done for free if you have a traditional savings or checking account. And given that these accounts are free for students, that is, you can find checking and savings accounts that are free, why a student would go to a check cashing outlet is beyond me. It makes absolutely no sense to pay a pretty hefty fee simply for someone to cash your check. There are also payday loan companies. Again, these are people who are struggling, living on a paycheck to paycheck basis. They will essentially give you very short-term loans, in a sense, kind of like a pawn shop. These tend to be short-term loans where they're loaning you money for a week or two. And just like at a pawn shop, the interest rate for these very short-term loans are very, very high. It's a bad deal for consumers. It's much, much better for you to get your spending under control so you're able to pay bills out of current earnings or perhaps out of previous month's earnings rather than borrowing money to pay a bill out of next month's earnings. Remarkably popular are rent-to-own centers. You've probably seen them around. They offer what appear to be attractive rates for you to rent, say a big screen TV or a washing machine or a refrigerator. These rent-to-own centers are terrible deals for customers. You are fooled by what appears to be the low monthly rate they're charging you, but if you actually add up the amount of money you will pay in rent during the period of time that you are building up the ownership equity in the, say, big screen TV, you will pay 2 or 3 times the amount you would if you bought the television set from Sears or from whatever store you choose to shop from. So rent-to-own centers are, again, essentially extremely high interest rate places. There's also car title loans. Again, these are people who will loan you money and take their collateral as the title to your car. These come, again, at very high interest rates, and unless you're willing to risk losing your car, these are not something you should engage in. One other comment I want to make on interest rates. This is discussed in the book. I do want to stress to you that this is important. Different institutions quote their interest rates differently. Okay, so this table is directly from the book. You can go to a bank and they can quote and tell you that they will compound interest rates annually, quarterly, monthly, or daily. Okay, so this is how frequently they add interest effectively to your earnings. So in each column, the quoted interest rate is 4%. The only difference is how frequently they compound. The easiest column to understand is the far right column. This is a column where basically you get your interest compounded once a year, okay? And so you make 4% a year, okay? If you go to compounding quarterly, okay, they actually compound 4 times a year. And that turns out to be, if you can imagine, slightly higher interest rate because you're getting interest paid, say, at the end of March, and then you're going to earn more interest in the next quarter on that interest. So, for instance, instead of having $10,400 at the end of 1 year, which is what you'd have if you compound annually, you'd have $10,405. So just simply going to a bank that compounds quarterly would increase your return by $5. If they compounded monthly, you'd have $10,407, or daily $10,408. Okay, so you can see the smaller the unit by which they compound, the better for you. If you looked over a long period of time, you can see that the compounding increases, and so the same $10,000 investment will grow to $22,254 if you had a bank that did daily compounding, which is about $350 more than the annual, which is a substantial amount more. So I want to just have you at least register that idea, that pay attention. You want to stay away from, if you can, from banks that compound annually. Again, on the whole spectrum of things you should care about, I would still say really focusing on fees, banking fees, for most of you is the primary thing you need to focus on. And the idea of focusing on how frequently the compounding probably is not your number one thing, but it's something to be aware of. That is a way to increase the return from an account. I want to talk about payment methods right now, and it's the last thing I'm going to emphasize in this chapter. The book talks about a variety of ways you can use to pay bills. Right, one simple thing could be traditional checks. In the modern world, there are a lot more options than checks. There are credit cards, debit cards, online payments like PayPal, stored value cards. These are not store cards, these are stored value cards. Many of you have experienced these, like with prepaid telephone cards or prepaid transit passes, where you pay for a month in advance to allow you to ride the train. Some of you may also have smart cards, or effectively smart wallets, so you can use your phone to pay your bills. I'm going to mainly talk about the difference between credits and debit cards. Okay, so these are important. These are very, very different types of cards, even though they look similar in your pocket. Okay, a credit card is you have an institution, say Visa or MasterCard, willing to loan you money for a short period of time to allow you to pay. Usually there's a maximum amount, say $2,000. Okay, and if you pay that money off every month, when they give you the bill, they do not charge you interest for that very short-term loan. Okay, a debit card, on the other hand, a debit card is when you use a debit card to, say, purchase something at the store, the money comes directly out of your checking account at the time of the purchase. So a credit card is money, you're paying for the item, but actually you're not going to truly take money from your checking account until you pay the credit card company at the end of the month. And a debit card is coming out right when you purchase it. There are pros and cons to each one. If you use a credit card, there's some advantage to delaying the payment. A huge advantage, which we will talk about again later in the course, is a credit card, responsible credit card, let me stress that, allows you to build a credit history. And a credit history is actually really important because when you go to borrow money from a bank to, say, purchase a car or purchase a house, good credit history will actually generate lower interest rates for you on loans. A credit card is useful if you buy something online. Often the credit card company will help you uh, uh, seek redress from a company that shipped you a defective item, for instance. And a credit card is desirable because many of them allow you to earn rewards, either cashback points or airplane miles are two popular ways you can use credit cards. And that's equivalent to about 1 to 3% of what you purchase you get back. A debit card limits your spending to your available funds. That is, so if you only have $400 in your checking account and you're using a debit card, you can't spend more than you actually have. For some people, that discipline is very important. It allows you to avoid future bills. Again, a credit card is you're just kind of kicking the payment of the bill down the street a little bit. The debit card, you get into the practice of paying for something when you purchase it. And really important is it's very difficult, especially for young people who are starting off, to pay their credit cards off every month. And so they get in the habit or the cycle of paying interest on credit card balances. Credit card balances, while not as high as some of the other types of loan, like check cashing loans, pawn shops, etc., credit card interest rates are very high and extremely difficult to pay off. A debit card allows you to avoid that because you're only able to purchase with the cash that you have. Let me say that the book talks about that the debit card is better protection for a consumer. I actually disagree a little bit with that. I think a credit card and debit card, each of them have advantages and disadvantages in terms of protection. If you have a credit card and your card is lost or stolen, the liability, so if someone is charging on your lost or stolen credit card, typically the liability to you is $50. And many banks, many credit card issuers will waive even the $50 fee. So that's attractive. On the other hand, debit cards have PIN codes, so a 4-digit code. If the person who has your lost or stolen debit card does not know your PIN, it's hard, if not impossible, to use the debit card. So I think it's actually, the book is essentially talking about that aspect of it. I will say that shortly, in the next couple of years, the U.S. is going to move towards moving credit cards to also having PIN codes. This is what Europe does, and it's much safer for consumers to also have a PIN code associated with their debit card. So those are the main ideas I want to draw your attention to from this chapter. I'll come back to some of these ideas in future chapters. Good luck studying.